Hello, everyone. My name's Lan, and you're in for a treat today. I'm here with the director and founder of CAZ Capital, Lan Nguyen, and today we're here to share something a bit different about not just tax and business, but about the economy. Because, as you know, we're in Victoria and we are at home in a lockdown. So a lot of my clients have been asking, what's going to happen post this lockdown? What's going to happen post JobKeeper? And therefore, I like to share, my view as well as Phil's view, who is obviously into, he's a director of a mining company and is into alternative investments. And we will both share our thinking of what you should do as a person, an investor, and as a business owner to prepare for this and to get well prepared for your family so that you come out on the other side thriving and not crashing. So over to you, Phil. What's your thoughts on what's happening in the economy right now?
Oh, wow. There is so much. Oh, hello, everybody. Thank you for inviting me. Firstly, Lan. We've been talking a lot and we've had some really interesting conversations in light of everything that's been happening in the economy. And this is a great way for us to share our views, and hopefully people will get some value out of it in terms of what's happening, and so they can make informed decisions for themselves and their family. So where do we start? that's the big question at the moment. There is so much going on. So let's look at some stats and look at what's happening in the economy before we talk about where we think it's going. How's that?
Perfect.
Okay. So what I will ask you to do is, I'm just going to grab the screen, if you don't mind, Lan.
Yep. Now, guys, obviously you may be keeping up to date with JobKeeper and what's happening and some things in the media, but there are things that that are not shown on the media that we want to tell you, to let you know what's happening, because if you know what's really happening, then you'll be better informed. So, and I think you got to hear it, the truth, right? Because the media is not always selling the full truth or the full picture. So Phil, when you're ready.
Awesome. Thank you. So I'm going to share my screen here.
And while Phil is doing that, if you have any questions, guys, please put in the chat box, and at the end of the show, Phil or myself will address it. So we would like to hear your feedback as well, and what or comments that you or if you disagree or agree.
So that'd be great. So what we have here is some stats from the ABS. So this is the latest stats. You can get it straight from their site.
I might get you to open it a bit larger, just for those who are on their phones watching this. Is that better? Yes, much better. Thank you.
Okay. So what we see here is right now, as of July, we've got an unemployment rate of 7.5%. So it hasn't been this high for probably the last 20 years. So that's an unprecedented situation that we're in at the moment. And what we have here is a GDP that is at negative. We've been growing, especially with our immigration, and our economy has been growing for many years now, since the last GFC. But right at this moment, with everything that's going on, we're actually in negative territory, which is it's expected under the circumstances. But the question is, what do we do, and how does that impact everybody? And the other interesting thing is CPI, which is related to inflation. So that's at a negative as well. So it's probably contrary to some of the news that if you're reading out there in terms of you're hearing about money printing and things like that, that inflation should be going up. Okay. But there's a delay in all that cycle. Right now, we're in a situation where we're in a negative CPI because spending is actually down, and costs of certain products that they use to measure CPI is actually got cheaper. A big example is petrol. And the other one is childcare. So there's been big concessions with childcare, and that all affects the CPI figures. So is it capturing the real economic situation out there? I don't really think so, okay, but it's just one measure. So we've got to go beyond the figures and really look at what's really going on. Okay. But this unemployment figure of 7.5 is, I'll share this a little bit more. We can show down here. This is the unemployment rate and the employment rate. You can see the inverse relationship here as the number of people were, unfortunately lost their jobs and so forth, or made redundant or on reduced hours. The number of people employed drastically reduced, where the unemployment rate jumped significantly. Wow. So it's a pretty alarming chart there. But what's more alarming, in my opinion, is that these figures do not account for what's happening with JobKeeper. The people who are on JobKeeper are not, they're not actively working on a day-to-day basis, but they're not also considered as looking for work because their job per se is still secured with their employer. So they're not a part of these figures. Now, JobKeeper is set to be looking after around about a quarter of the actual working population, you know what I mean, help subsidizing that. So you can imagine if we added JobKeeper onto this figure, we'll be in the 30%. That is incredible. So we're in, you've heard in the news lots of time, we're in unprecedented times. So what's our government doing? What are the different departments doing? That's the next question, I guess. So this is where we are as a capture of the main indicators of what's happening in the economy. But these are some of the things, some of the notes that I've taken that I thought that was important that I would like to share. So a lot of these are the departments within the government that have a lot of impact in terms of this type of policy under these times, which is the, so that should say APRA.
Yep.
RBA, yes. And the Treasury, so the AOFM. So why is APRA important at the moment? Is that they're the ones that regulate all the banks in Australia. Now, recently, with all the mortgages and the mortgage relief, they're the ones that passed the law that allowed the banks to pretty much give everyone a break that if you're struggling at the moment. So this is the link that you can go and look on about more information on that. But even with this concession that we have at the moment, that's not going to last forever. Okay? Yeah. And the APRA law itself, it says that, look, by March 31st, 2021, all bets are off. Okay, we got to draw a line in the sand somewhere and says that, okay, yes, we are in a pandemic. Yes, we do need support, but that support needs to stop at some point or needs to tether back. Okay, and that's at this moment at 31st of March. So we've still got time. So if you're still struggling out there, know that the government's trying to support you. However, it can't go on forever. So you've got to start thinking, what's going to happen? Do I need to retrain? And if I don't know what situation you're in, you know what I mean? And what situation your family's in. So you need to start making decisions knowing that this is not going to last forever. If you've got savings, what are you doing with it? If you're in between jobs now, how are you going to position yourself that by that time you're in a good place?
We will talk about that in the third part. So we'll
yes.
get the sequence. Yeah. So Um, Bill, so APRA you mentioned is for the banks and Reserve RBA. Just quickly, why is it so important? I mean, a lot of people know that the Reserve Bank issue the interest rate every Tuesday, and the first of Tuesday every month. But why is it so significant when they hold rates or they cut rates? And more so the monetary policy, how would it affect the Australian people?
Okay, so the Reserve Bank has got a role of, so it's not just so cut and dry that they just look at the rate. They're responsible for a whole range of things, but cutting the rate affects the whole commercial banking cycle. So the Reserve Bank is the start of everything, where they control the rate, and from that is where the commercial banks, you know, your big four banks, your CBAs, your NABs, and all that. That's where they're gonna get their rate from. So the Reserve Bank they don't actually set a rate. They actually incentivize the bank through their issuing of guaranteed securities at a certain rate, above or below the rate that they're going for. For example, right now, if the interest rate was really high, then the economic state of the is that people would have to use more of their income to actually service their loans. So when you do that, you're not spending as much. So economic activity actually reduces. So one of the tools that RBA has to stimulate the economy is to actually reduce the rate. So when they reduce the rate, that means you've got more liquid funds available that then you then go spend, and then that stimulates the economy. You're more likely to invest and things like that. But the RBA has set a rate or a target rate of 0.25, which is the lowest on record. There's virtually nowhere for them to move. They're right. almost at zero. So in terms of a tool that they normally have to try to impact the economy and adjust certain things, they don't have much left in their tank or much weapons left to help the economy. They're at as low as it can be. So with the APRA suspending payments for people who are struggling, and the RBA already at their lowest point, there's not much else they can do.
Except for hand out money, JobKeeper.
Right.
And
That's right. So government policies come out saying, okay, we need to actually help the economy. So what's been happening is they've been printing a lot of money. So JobKeeper needs to come from somewhere. Okay, and that's the role of another group. Okay, so up here there was a couple of groups. This is it's a department within the Treasury, AOFM. So it's Australian Office of Financial Management, and they're the ones that actually, when the government says I need money, they're the ones that actually go out and they sell government bonds pretty much, and they sell bonds to other reserve banks from overseas. They can even sell to big institutional investors like super funds. Even the banks buy them, okay, because they are guaranteed bond from the government and they pay an interest. And it's a bidding war, pretty much, a process that they go in, and it's a reverse bidding process where they bid for these bonds. And when they sell the bonds, that's how they get the money. So to service a lot of this, we've actually sold something like, the government sold something like $300 billion worth for the stimulus packages. So that's added to our deficit. So they're printing money per se, because really that money is just a promise for the people, us, to pay that money back somehow.
Yeah. So for those viewers who just joined, because I think people are starting to join now, why is it so bad for the government to print money? I mean, I know it, you know it, but why is it? Because I mean, as an accountant, a lot of my clients are asking, I really, love to be on JobKeeper 2.0. How do I meet the criteria? But that's really near short-term sight, yeah, short-term goal. How is it all these billions of dollars printing money will affect them in the future? Because that's what they need to hear, right? And then obviously, how should you prepare for this? Because it's not, once you get the free money, you're going to pay it back in a future date. What do you see our economy paying back, and in what form?
Okay.
I guess, and is this your view, of course, because government policy is unknown at the moment?
That's right. So as we all know, there's no such thing as free money. Somehow, somewhere, some way, you're going to have to pay that back. Okay. If it's today, if it's in the future, that's a different question. But as soon as that money gets printed, now there's a few things that happen. One interesting thing is in the economy is when the government produces this money, they're the ones that get to use it first.
Mm.
Okay. So when they print that $300 billion and they've used it for a project or stimulus or whatever it is, it's at the full value of the dollar. Okay. But slowly that money trickles into the economy. And now the overall money supply of the economy has just grown by that stimulus amount.
Right.
Yeah. So slowly as it trickles down and it gets through to the corporations, through to the retail customers, through to then to yourself, by that time, the economy has expanded. So now that has an effect on the buying power of the dollar. The government got to use its full value. By the time you get to use that dollar, it's no longer there. Okay, because prices, as you know, gets adjusted over time. So when the economy expands to absorb all this money, you don't get to spend that dollar. It's not worth the dollar anymore.
And therefore, prices of food go up, as we see, not just since COVID. Everything's gone up in prices. What we need has gone up.
That's right. That's right. It affects the whole economy because a price change in one area affects everything. Why? Because in let's say a supply chain or a manufacturing chain, it just takes one link in there to increase in price. It makes everything go up.
So it sounds like there are terms like stagflation, which means that prices go up, but productivity is, given the lockdowns and that, we're not producing as much. So can you just explain the difference between stagflation and inflation and deflation? Because I think that links to what you're trying to explain to our viewers, and how, and I guess where do you see that in the next 6 months, 12 months?
So for me, that comes down to capacity. So what that means is you've got a situation where stagnation is where you got extra capacity, where you're producing more than what you need. So the economy is not absorbing it quick enough, or there's still capacity. Where inflation is where you're at max capacity, but you want more. You keep wanting more, and there's demand, and that drives up prices. It drives up and it's not, because the economy works in different sectors as well, because it will affect things differently in different sectors. Okay? And deflation is when there's just excess, so you need to deflate everything so it comes down.
Yeah.
So that's the three type of scenarios for. But is that clear enough in terms of describing what it is, or?
Right now, do you see a deflation happening environment where everyone's not really spending because they're restricted in the lockdown, but there is a money supply there that is obviously generated for all the government stimulus and grants, and therefore a deflation is happening? And what's so bad about that? I mean, if you would say what's so bad about any of that to me?
So depending on what economic theory you're looking at, it could be good, bad, or
But I guess with deflation, what that means is that obviously, not what my understanding is not what the Reserve Bank wants. Reserve Bank wants a minimum inflation of 2%.
that's their target, yes.
But if our economy is in this environment right now, then they will continue to want to supplement and print more money until when they reach their 2%, which unfortunately they will overdo it at times. So eventually there will be the reason why of deflation as well is people are not actually the velocity of money. So people are not actually spending that money they get from the 10K grant or the JobKeeper. They're actually saving it or paying down debt. They're not actually releasing it to the economy, going out to restaurants and traveling because they can't.
They can't. Right.
So potentially until next year, when the COVID is under control, maybe a vaccine or we learn to live with COVID, then velocity of money will pick up eventually because people will be going out shopping and hopefully traveling soon, so that then you'll find that there's so much supply of money, and then the reverse will happen. Potentially inflation will happen, or hyperinflation. Yes. And what's so hyperinflation?
That's it. We're petted up at the moment, and everything's suppressed at the moment. Okay, all the things that we want to do, we can't, and the money's a reflection of that. Okay, and people, one thing you said in there, if you're paying off debt, that money doesn't go into the economy. It doesn't stimulate the economy, because when you're paying off debt, the money doesn't flow. And that's where the money velocity is really important, because the quicker it flows, the more, there seems to be more of it out there. Now, what's happening at the moment, we're in a deflationary type environment, but coming out of it, it's going to be very inflationary, because you've got so many factors that are working against the economy. There's some that are working for the economy at the moment. For example, interest rates. When the government is borrowing all this money, one thing's working for the government is the interest rate is so low. Yeah, which is in a sense, it's an interesting theory, because as the money is low, and if they keep printing the money, and if the one way that the government can pay this off is through inflation. So if inflation is higher than the interest rate, then what happens is proportionally that amount of debt actually reduces over time. Yeah, which is one way that governments actually, over time, the debt amount looks low, looks small. However, the effect of that is that means as a person on the street, your dollar and your buying power has also reduced over that same amount of time. So, for example, what that means is, if like we have got that $300 billion in terms of debt, but the government's able to sell bonds at very cheap rates because interest is low at the moment, they might be able to sell it at 1%. And in a certain, in a couple of the auctions that they had recently, the rates were below 1%. So that's cheap money. Now, if inflation is then at 3%, there's that 2% difference. So every year, your debt as a proportion is actually reducing by 2%. But then the buying power of your dollar, once that money's in the economy, is actually reducing as well.
That's right.
So there's this. So the government's happy because their debt's going down proportionally, but as a consumer, your buying power has just reduced as well.
And I would say that the winners and losers of this is the ones who have the debt, the assets, the real assets, such as houses and property, commodities, gold, silver. They're the ones that will hold preserve their value. The ones that are just holding the dollars or the Australian dollar, such as your hard mum and dad business owners who don't have a house, for example, who just all, employ people going to work, who probably don't invest. They're the ones that are finding that, okay, my 100K salary is not buying as much as a basket of 100K 12 months ago, so that leads us to the next question. I might get to the JobKeeper update. So as you know, business owners can be, you can see it's blessed or not blessed. We have the extension of JobKeeper 1.0 to expand to 2.0. So although the laws are tougher to get in, because they're trying to wean off the business owners off the government support, which I think is a good thing, even though it is, it's I feel that you're damned if you don't, and damn if you do, in terms of supporting the business owners. But for now, because Victoria and obviously other states are still restricted in how they operate, then the short term, use the JobKeeper. I advise my client, use the JobKeeper as a way of deleveraging your debt for now to build yourself in a stronger position. Because as Phil mentioned, and obviously a lot of, all the research I've done too, the economy post-COVID is not a pretty sight. You need to prepare. Okay, so I won't cover the updates so much in JobKeeper, because that is already covered with my another video I did with Koi last few weeks. So if you're into how to be eligible in JobKeeper 2.0, please revisit that video. But I wanted to take us to the next point, which is, as an individual, who's an employee, as an investor and as a business owner, how do we prepare for this aftermath of COVID? Because I think if you are well prepared, you should be able to get unscathed. If you're not well prepared and you're not aware of what's happening, I think you will be in for a shock. So you first, Phil.
Yeah, my opinion. Well, looking at history, coming out of the GFC, one of the what we saw was this was the first time where things like quantitative easing was actually used and applied in the economy. So that started in the States, but we did that here as well. Now,
quantitative easing, for those who are just new with the technical term, if you could just quickly explain.
Quantitative easing is very similar to the stimulus pack, where the government goes out and creates all this money out of pretty much thin air, out of agreements, selling their treasuries and bonds and things like that. And then what they were doing is, especially in America, they were buying up all the bad debt in the economy. Instead of letting the banks that caused the actual financial situation happen, instead of letting them fall and flushing out all the bad banks and that type of thing, they actually went in and gave big checks so they could rebalance their books, get rid of the bad debt so they wouldn't go under. Now, that cost billions and billions of dollars. And that propped up the economy even further. So in a way, yes, we didn't have bankruptcies of banks and things like that under the GFC, but all that money had to flow into the economy somewhere. Yeah. And coming out of that, one of the big winners was people holding assets. Because asset prices, a lot of that money went into asset prices. Yes. So things, if you had property, if you were holding gold and silver, things like that, those hard assets, commercial, residential, all of that started to grow. And we saw significant growth after the GFC. And the same thing's going to happen this time. People holding assets are going to be the winners. Because that's right. Because when inflation and all that starts setting in, we have an inverse relationship where it's not so much that asset is, let's say, getting more valuable, but what's happening is, because there's so much money in the economy, the value of the dollar is going down. So that asset now is worth more in terms of dollars, but it doesn't mean that your asset actually is worth anything more. What I mean by that is, let's say your house at the GFC was worth 500,000, and post GST, take away, 6, 7, 8 years, you look at it and go, wow, it's doubled in price, which is great from a monetary point of view. But did it double in value? Can you now take your house? It's doubled. Can you go buy the house next door with that? What your house is worth? No, because their house has gone up as well. Okay, so the asset value has gone up in dollar terms, but doesn't mean that your asset's gone up in terms of value. But if you're not holding that asset and all you're doing is holding the dollar, the dollar just got reduced by half in terms of when you're trying to buy that asset.
Yeah.
So
that's called debasing, isn't it? Debasing of the Australian dollar, and which is really scary, because a lot of baby boomers are retiring, and there's super funds normally in the invested in share markets, and obviously a lot are saving cash, which is losing value every day, especially during this time. So for those who, let's go with an individual now. Let's say if for those newbies who have no assets at the moment, what should you be? I mean, we are not advising anyone or recommending, of course, because this is only general advice and general information. If you are interested in getting started in your investment, please leave a chat, and then I'll get you in touch with one of my team. But for those who are thinking, crikey, I heard Phil speak and Lan speak about almost doom and gloom for those who haven't got assets. Then what are the, let's say if I had no assets right now and I'm just a business owner or employee, what should I be looking at now? What would you do first thing?
Put a plan in place. That's the number one thing. What's your goal?
Financial plan, yeah?
Yeah, financial plan. You got to have some objectives out there. You know what I mean? And the reason you probably don't have any assets is because you never planned in the first place. So that's important. So you got to have a plan. You got to know what you're trying to achieve. And we all know the richest people in the world are the ones who hold all the assets. If you have no assets, really, how rich are you? How wealthy are you? You might be a little bit cashed up, but when you're controlling, what are assets? Assets are things like we said, like property. Talking about a company or a good business can be an asset, but those two asset classes cost lots and lots of money to get started. I'm in the restaurant business as well, and my last restaurant cost me like $750,000 to get started. But if you are only getting started, look at something that you can start today. Something like precious metals is something that you can do. Have a plan. Maybe reserve 5-10% of your income to start accumulating some type of asset. Okay. Yep. And once you've got a plan to start accumulating that asset, then you can start moving between asset classes itself. Okay. Once you've accumulated enough capital in that asset, then okay, you've grown something. Now let's see if you can move into a different, like a business, like property, like something else. But if you don't start anywhere else, and if you're trying to save up the money to do that, it's going to be a much, much more difficult road, in my opinion.
Yeah. So number one is to start having a life plan or financial plan of, what your goal is and I guess the path to get there, because, before COVID, everything was booming, the economy was going smoothly. Post-COVID, it's not like that. It is actually those who have the plan that will actually most likely survive and thrive. The ones who have no plan, who are just plodding along, they're the ones that are going to get burned. And it's not too late, because everyone is still, in 8 months left, right? With COVID, 6 to 8 months where the government is supporting you. Everyone is at home now. You have more time on your hands. Now is the time to get educated, learn about what you seek help if you don't know where to start. But that's a good point. So for those I guess for investors and business owners, I deal a lot with. So I would say that for business owners, why don't you have a look at, okay, so obviously assess if you are eligible for JobKeeper 2.0. And even if you are or you are not, make sure that you have, a cash flow buffer, a buffer for your next, 6 to 12 months, just in case if you miss out on JobKeeper. What are you going to do? How do you sustain? Is your business can sustain? What is your fallback plan? So we call it a plan for rebounds of the business. Not many people have a plan for their business longer than next week, like in terms of clients and what to do. So if you don't have any plan, then put a plan in place. For investors, property investors out there, obviously as you hear Phil, and the banks are not going to offer you that extension past, I think is it 4 months or March? But
March 31st.
March 31st. So how you look at your portfolio, repurpose your portfolio, see which ones should stay, which one should go, and refinance if you need to do it now. So all of these things, what we're bringing in is like, we know that right now is actually the honeymoon period. Is actually the good period, because you are supported by the government. In 8 months, when the government cannot continue to support. And the reason why is because they can't continue to print and print money. And if they do that, then hyperinflation will go up. So either way, they have to stop somehow. So that's why we're putting together these videos and to make you awaken the Australian people that now is a fantastic time to plan. Okay, you have at least 6 months leeway, a head start to do that. So yeah, so Phil, any last words for our viewers today? Of anything you want to cover, or?
Not so much cover. I'm just wishing everyone luck, but just along with what you're saying, we still got time. This is it. You know what I mean? The news out there is all doom and gloom, but I don't think that's the case. We are in a period where we are supported. So if you are struggling, here's the time, make a plan. There's still opportunities, especially coming out of a big economic crisis like we saw at the GFC. The biggest opportunities actually are created and come out of it. If you survive this, okay, there's actually a good chance that you'll actually do better. Okay, yeah. If you're doing well during this period, you're going to do exceptional afterwards, but it's not going to be easy. Like Lan said, the government is starting to reduce all its support over time. And once that all happens, are you ready? Okay, is your plan solid enough to take you through? Because despite what the RBAs, they've got certain scenarios that they play out, and they're saying that they predict. They're saying we'll recover in 1 or 2 years. My personal opinion is it's going to take longer than that. Okay, but it doesn't mean it's all doom and gloom. It means that during that time, there's going to be opportunities for you to take strategic action to set yourself up. So when the economy starts improving, things like immigration, one of the big things is over the last 40, 50 years is immigration. We've continued to grow over this time, and our GDP has kept on growing over this time is because of immigration. And right now we don't have that. But when it comes back, when our borders are open, that immigration, I believe we're going to have a massive influx, like we haven't had in recent times. We had a steady flow, but because of what's happening, when that comes in and you're set up for a good burst in the economy, and the economy is going to grow and you're ready for it, you're going to take advantage of all that opportunity. So, I know it's going to be hard, but make a plan. Make sure you're able to stick it out, because there's still good times coming. And if you plan well, you're going to do well.
Yeah. You muted, Phil.
Oh.
Okay. And just to add to that, you know, I'm an investor. So in terms of pandemic crisis, um, prices of assets are actually cheaper. So this is a great opportunity for those investors who are, you know, or not just investors, for people who want to get into assets because they're actually cheaper, they're on sale. Okay, so do your research. You know, if you, it is a time to look into those devalued assets and make your move, but you can't do that without a plan. So look, thank you very much, Phil. I think we've covered a lot of ground. It's been very interesting to have you on, and you know, certainly different to what we normally cover, which is normally JobKeeper, tax and accounting and business. But I think like it is important to discuss what is happening in the economy, and so that our investors, business owners, and just the Australian people know what they should be aware and be well prepared, so that they can thrive, which is all about what's in our community. Thank you again, and please leave if you're watching, please make sure that let us know that you're watching, and yeah, and smash that like button so that more people can see this video, and also share the message. Thank you again, Phil. And
thank you for having me on. It was a great discussion. Really enjoyed it. Thank you.
Okay. Thank you, everyone. Bye.